Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate finance, and I have a real treat for you today. We are diving into OTG Acquisition Corp 1's latest filing, and let me tell you, it involves units, ordinary shares, and a whole lot of warrants. So get ready to decode some IPO and before we get started, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community, linked in the description below, where we break down these filings even further together. So what is this document all about? Well, it is a current report, which basically means it is a statement from the company about a major event that just happened. And in this case, the big news is that OTG Acquisition Corp 1 completed its initial public offering, or IPO, on the 15th of September 2025. Sounds pretty standard so far, but let's see what makes this one tick. This company, OTG Acquisition Corp 1, is what is known as a Special Purpose Acquisition Company, or SPAC. They are essentially created to raise money through an IPO to buy an existing company. This filing is telling us that they successfully raised a significant amount of money right out of the gate. Now let's talk about what they actually sold to investors back in September. They offered units, and each unit was a package deal. It contained one Class A ordinary share, which is like a piece of ownership in the company, and then half of a redeemable warrant. Now, what is a warrant, you ask? Think of it like an option, a ticket that gives the holder the right to buy a share of the company's stock at a specific price, usually in the future. This is a common structure for SPACs to make their IPOs more attractive to investors. Let us get to the money for their IPO. They sold 23 million of these units at $10 per unit. That is a cool $230 million raised. Now, they also mentioned that the underwriters fully exercised their option to sell an additional 3 million units, which means they raised even more money through that option, bringing the total from the IPO potentially even higher when you factor in the over-allotment. But wait, there is more. Alongside the main IPO, the company also carried out private sales of what they call private placement units. These were sold to the company S sponsor and the IPO S underwriters. A total of 775,000 of these units were sold at that same $10 per unit price, bringing in another $7.75 million. So in total, they raised a substantial amount of money, over $237 million. That is a lot of capital to fund their future acquisition. Now, here is a really important part for SPACs. Most of the money raised from the IPO and the private placements gets put into a trust account. This money is held by a trustee, and it is essentially earmarked to fund the acquisition of the target company. They placed a massive $231.15 million in this trust account, a very safe place to keep it until they find their business to combine with. They also attached an audited balance sheet as part of this filing. This is basically a snapshot of their financial situation, right after the IPO, showing all the money they just raised. It is a crucial document to see the immediate financial impact of their public offering. Let's revisit these units a bit more because they dictate how the company's stock is traded. These units themselves are traded on the NASDAQ under the symbol UTGAO. You can't buy a unit that includes both the share and the warrant. Then you have the ordinary shares, which are traded separately under the ticker symbol OTG. These are the actual ownership stakes in the company. And finally, the warrants have their own ticker OTGOR. Each whole warrant can be exercised to buy one ordinary share for $11.50. This exercise price is key because if the company S share price goes above 11.5, these warrants become valuable, creating a potential profit for their holders. This filing is made with the US Securities and Exchange Commission, the SEC, which is the government agency that oversees the securities markets. They ensure that companies are being transparent with investors and that the markets are fair. One interesting detail here is that OTG Acquisition Corp 1 is identifying itself as an emerging growth company. This means they can take advantage of certain benefits and flexibilities under the law that are designed to help newer companies grow. One of these benefits can be delaying the adoption of new accounting standards. But they also mentioned they have elected not to use that extended transition period, so they are going to be following the latest accounting rules from the start. This part just tells us the legal basis for filing this report. They are complying with the rules set out in the Securities Exchange Act of 1934, which governs how and when public companies must disclose information to the public. The key date for this report is the 15th of September 2025, which is when their IPO actually happened. There are a few checkboxes here that are usually for SPACs to indicate if this filing is also acting as a notice for other specific types of communications. For example, communications related to mergers or acquisitions talks. This filing itself is just about the IPO closing, so most of these are likely not checked. Now let's talk about the bigger picture here. We have a SPAC, a blank check. Company, that has successfully gone public and raised a significant amount of money, their main goal now is to find a private operating company to acquire and merge. With the success of this SPAC will depend entirely on the quality of the company they eventually choose to buy, and the terms of that deal. The fact that they are trading units that include not just shares but also warrants suggests they are trying to appeal to a broad base of investor staff, or including those who might want to participate in the potential upside from the acquisition. The market for SPACs has been quite active, but also subject to shifts in investor sentiment. If OTG Acquisition 1 can identify a strong target company with solid growth prospects and execute a fair merger agreement, then the investors who bought into this IPO could see good returns, especially if those warrants become in the money, meaning the value of the underlying shares surpasses the warrant exercise price of $11.50. However, there are inherent risks with SPACs. The management team has to make a critical decision about which company to acquire, and they have a limited time frame to do so. If they do not find a suitable company and complete a business combination within a set period, usually 18 to 24 months, the SPAC typically liquidates and returns the money to investors, minus some expenses. This means the sponsors and management have a strong incentive to get a deal done, even if it is not the absolute best deal possible, looking at the numbers from an investor perspective. The IPO successfully raised over $237 million, and most of that is held in trust, ready for an acquisition. This shows confidence from investors in the management team, its ability to find and execute a deal. The success of the warrants hinges on future performance, a common feature in these types of offerings that can amplify returns for early investors when things go well. So to wrap up OTG acquisition, Corp 1 has completed its IPO, raising a substantial war chest. They are now in the Hume NT. For an acquisition target, the game is now about execution, picking the right company, and navigating the merger process effectively. What do you all think about this SPAC IPO? Are you excited about the potential for a future acquisition, or do you see the inherent risks in the SPAC model? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more in-depth corporate analysis. Don't forget to join our Discord community linked in the description for more insights. Thanks for watching. See you next time.